Hey everyone, and welcome. Today we're diving deep into Malaysian income tax because, well, a huge rule, a really foundational one, just got a massive rewrite for 2024. And listen, if you own a business or you're investing in companies, you're going to want to stick around for this. It's that important.
So, let's get right into it. Think you've got a handle on what's taxable in Malaysia? Well, you might want to think again. Because as of this year, 2024, the game has seriously changed. And we're talking about a change that could hit the value of your assets directly.
Okay, but before we jump into what's new and exciting and kind of scary, we've got to take a step back. We need to understand the one golden rule, the single most important idea that's been the bedrock of Malaysian income tax for decades. Seriously, everything is built on this.
It's something called the scheduler system. I know, sounds super technical, right? But trust me, the idea behind it is incredibly simple. Here's the deal. In Malaysia, your income isn't just automatically taxed. Nope. For the government to tax it, it has to be on a very specific list, a class of income mentioned right in the Income Tax Act. I love this analogy. Think of it like a super exclusive VIP club for taxes. If your type of income isn't on the list, it's not getting past the velvet rope. It's just not taxed. Simple as that.
And for the longest time, that VIP list has been pretty consistent. It's always had the same 6 main guests, you could say. These are the classic, traditional income types that have been the backbone of the entire tax system for ages.
So, what are they? You've got your business profits, of course. Then your salary and earnings from a job. You've got dividends and interest payments, rental income, royalties, that kind of thing. Pensions and annuities. And finally, there's this little catch-all bucket for other random gains and profits. For decades, this was the deal. If your money fit into one of these 6 buckets, boom, it was taxable.
And believe me, these buckets are super specific, laid out in the law. Take Section 4B. That's the one most of us are familiar with. It's all about your salary, your bonus, any perks you get from your job. Then there's Section 4A. This one's for the hustlers, right? The entrepreneurs, the freelancers. It covers all the profits from your business or side gig.
In another really common one, Section 4D, that's where your rental income goes if you're a landlord. See, the system is really clear about what's in, but that begs a really important question, doesn't it? What about the things that were left out?
And that question, my friends, brings us to the Great Divide. Because for years and years, there was this massive, huge category of financial gain that was very, very deliberately kept off that VIP list.
The best way to get your head around the old rule is with this awesome analogy, the fruit tree. Okay, so imagine your assets, your factory, your shares, are a tree. The tax office always said that income, things like rent or your business profits, well, that's the fruit that the tree produces every year. And that fruit, oh yeah, that's taxable. But capital, that was the tree itself. So if you decided to just sell the entire tree in one go, that profit you made was called a capital gain. And for the longest time, it was generally not taxed. But you see that little asterisk there? Yeah, that's a hint. A big one. It's basically screaming that the clear line between the fruit and the tree was about to get very, very blurry.
And here we are. The plot twist, the game changer. A brand new tax has just walked onto the scene, and it's completely redrawing that old line in the sand between income and capital.
Think about it. Before this year, before 2024, if you sold a big capital asset, say your shares in a company, that profit wasn't even considered income. But then bam, January 1st, 2024, the government rolls out this new provision, Section 4AA. And just like that, overnight, capital gains tax, or CGT, is officially part of the Malaysian income tax framework. So this little piece of legislation, Section 4AA, this is the engine driving the whole change. What it does is create a brand new 7th bucket for our tax VIP list, and its definition is pretty straightforward: gains or profits from the disposal of a capital asset. Make no mistake, this is a huge deal. It's a massive step to broaden Malaysia's tax base, and it officially slams the door on the era of tax-free capital gains for a lot of assets.
Okay, so the big question, who's on the hook for this new tax? Well, it's aimed at companies, limited liability partnerships or LLPs, trusts, and cooperatives. But, and this is probably the most important takeaway for a lot of you watching, for now, individuals are excluded. Let me say that again. Individuals are excluded. So if you're just selling your personal shares on the Bursa Malaysia, don't panic. This new rule doesn't apply to you. This is aimed squarely at business entities.
So what exactly are these capital assets we're talking about? The law is pretty specific here. The main target, the big one, is the profit you make from selling shares in unlisted companies. So, private companies, not the ones on the public stock exchange. It also ropes in shares of some foreign companies if their value comes from Malaysian real estate. And interestingly, it covers gains on foreign assets if a Malaysian resident brings that money back into the country.
All right, so that's the what and the why. Enough theory. How does this actually work in the real world? Let's get practical and walk through a quick example to see this new tax playbook in action.
Okay, imagine a company decides to sell its shares in some hot unlisted tech startup. They sell them for $500,000 ringgit, so 500,000. That's our starting point.
But of course, you don't pay tax on the whole amount. Next, you get to subtract your costs. So, what did the company originally pay for those shares? And what about other costs, like legal fees for the sale? Let's say all that adds up to 310,000 ringgit.
Simple math. 500,000 minus 310,000 leaves us with a chargeable gain of 190,000 ringgit. Now that is the number we care about. That's the profit the tax is based on.
And now for the final, easy step. The tax rate for this new CGT is generally a flat 10%. So you take that 190,000 ringgit gain, multiply it by 10%, and there's your answer, a tax bill of 19,000 ringgit. Done.
Now hold on, I know what some of you are probably thinking. Wait a second, didn't Malaysia already have a tax on selling property? And you're absolutely right, but that's the Real Property Gains Tax, or RPGT, and it's a completely different beast. RPGT is its own separate law, it's all about land and buildings, and it hits individuals too. This new CGT we're talking about, it's inside the main Income Tax Act, it focuses on things like unlisted shares, and remember, it doesn't apply to individuals. They're two totally separate systems, so it's really important not to mix them up.
You know, this quote here really just nails it. It says this marks a new era in Malaysian taxation. And that's not an exaggeration. This isn't just some tiny tweak to the rules. It's a fundamental shift. It's taking a whole category of profit that used to be outside the tax system and pulling it right into the income tax net for the very first time.
So let's wrap up with this final thought. For any business, any investor, anyone dealing with company transactions in Malaysia, the ground beneath your feet has literally shifted. Capital gains tax isn't just some idea being debated anymore. It's here. It's a reality. And that leaves just one big question on the table. Is your investment strategy ready for it?